Profitable companies go bust every day. The reason is almost always the same. They ran out of cash. In the next few minutes, I'll give you the two-number survival kit, cash flow and break-even, that keeps a young business alive long enough to win. Let's start with the idea that catches every non-financial founder off guard. Profit is not cash. Your profit and loss statement can show a healthy number while your bank account is heading for zero. How? Timing. You book revenue the moment you raise an invoice, but the customer might not pay for 60 days. Meanwhile, you've already paid your supplier, your salaries, and your software bills. The profit is real, but the cash to cover next month's wages simply isn't there yet. That gap between profit on paper and money in the bank is exactly where startups die. This is why investors and endorsement assessors read a third statement alongside the profit and loss and the balance sheet, the cash flow statement. It answers one blunt question: where did the money actually go? It splits every movement of cash into three buckets: operating activities, the cash from running the business day to day; investing activities, cash spent on or raised from longer-term assets; and financing activities, money from investors and lenders, and repayments back to them. Read together, these three show whether your business generates cash or quietly consumes it. For an early-stage company, two numbers from that statement matter more than any other: your burn and your runway. Burn is how much cash you're losing each month. Runway is how many months you have left before it's gone. The maths is brutally simple. Take the cash in your bank and divide it by your monthly burn. Suppose you have 90,000 pounds in the bank and you're burning 15,000 pounds a month. 90,000 divided by 15,000 is 6. 6 months of runway. That single number tells you how long you have to hit your next milestone or raise more money, and it's one of the first things a sharp investor will ask you for. Now the second survival metric, break even. To get there, you first need one concept: contribution margin. Contribution margin is simply your selling price minus the variable cost of delivering one unit. Say you sell a subscription for £50 a month, and the variable cost to serve one customer, payment fees, support, hosting, is £10. 50 minus 10 is 40, so every customer contributes £40 towards covering your fixed costs. That £40 is the engine of the whole calculation. Break-even is the point where total contribution exactly covers your fixed costs: the rent, the salaries, the subscriptions you pay whether you sell 1 unit or 1,000. The formula: fixed costs divided by contribution per unit. If your fixed costs are £20,000 a month and each customer contributes £40, then 20,000 divided by 40 is 500. 500 customers and you stop losing money. Let's sanity check it. 500 customers at £50 is 25,000 in revenue. Their variable costs are 500 times 10, so 5,000. That leaves 20,000 of contribution, exactly equal to your fixed costs. Profit, 0. That's break even. Here's why this matters for your visa plan and for running the business. When an assessor asks, "When do you become profitable and why?" a vague answer loses you the room, but this wins it. Our break-even is 500 subscribers. Based on our current growth, we reach that in month 14. We have 18 months of runway to get there, and here's what changes if churn runs higher than we expect. That sentence, break-even, the date you hit it, and the runway to survive until then, is the sound of a founder who actually understands their own business. So watch your cash, know your break-even, and you hold the two metrics that decide survival. The full worked examples are in the Financial Fluency series at torlyAI. Run a free assessment while you're there. And when you're ready to build the model itself, that's where the IPOC Financial Modeler comes in. This has been educational, not financial advice. Always check current figures and your own numbers with a qualified accountant.